Welcome to News Explainer. Today, we're examining the recent United States credit downgrade by Moody's and the direct message financial commentator Jim Cramer has for investors regarding the risk to stocks.
First, what exactly is a credit rating? Think of it as a financial report card for a borrower. In this case, the United States government. It assesses the likelihood of the government paying back its debts. Moody's, a major global credit rating agency, downgraded the United States government's credit rating on Friday, May 16, 2025, from its highest AAA rating to AA1. This signals that Moody's perceives a slightly increased risk associated with the nation's debt.
Why this change? Moody's highlighted several factors: the United States government's large and growing national debt, ongoing significant budget deficits, and concerns that this debt is becoming harder to manage. The agency anticipates that federal deficits will widen, potentially reaching nearly 9% of gross domestic product by 2035, driven by higher interest payments, increased entitlement spending, and relatively low tax revenue. Moody's also noted that successive United States administrations in Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. This isn't the first such downgrade for the United States. Standard & Poor's lowered its rating in 2011, and Fitch Ratings did the same in August 2023. Moody's decision now brings its rating more in line with the other two major agencies.
So, how does Jim Cramer suggest investors react? On his show on Monday, May 19th, his message was unequivocal. Don't panic, don't rush to sell stocks. Cramer emphasized that, historically, selling stocks due to national debt concerns has usually been the wrong move for investors. While acknowledging that the United States has way too much debt, he described the idea of exiting the stock market over a problem that might become serious in the distant future as totally counterintuitive and wrong.
Cramer suggested that any market dips resulting from these debt worries could be an early warning to invest more. He clarified this means investing more of what one can prudently save, not necessarily taking on more risk. He believes that staying invested can be a real hedge if one is concerned about the government's creditworthiness. Cramer also expressed strong skepticism about those urging investors to sell, implying they are either misinformed or short sellers aiming to create fear for their own benefit. For individuals still worried about government spending and debt, Cramer has previously pointed to assets like gold and Bitcoin as potential hedges.
What was the immediate market reaction to Moody's downgrade? On Monday, May 19th, following the downgrade announcement late Friday, May 16th, stock futures experienced some initial downward pressure, and the Standard & Poor's 500 and Dow Jones Industrial Average opened slightly lower. The 10-year Treasury yield, which is the interest rate the United States government pays on its 10-year bonds, briefly rose. However, markets largely recovered from these early dips, with some indices even finishing the day slightly up. This suggests that, much like previous downgrades, investors generally absorbed the news without major alarm, as many analysts believe the downgrade didn't introduce new information about the United States fiscal situation.
However, the downgrade is not without potential consequences. Mortgage rates, which often track the 10-year Treasury yield, are a key concern, and such downgrades can exert upward pressure on borrowing costs. This is occurring during the important home buying season, potentially adding more strain to the housing market. Despite this, analysts generally do not foresee a massive, forced sell-off in the Treasury market, as the downgrade doesn't legally compel banks or other nations to sell United States debt.
In summary, Jim Cramer's message following Moody's United States credit downgrade is to steer clear of panic-selling stocks. While the substantial United States national debt remains a serious long-term challenge, Cramer and other market observers do not view this specific downgrade as a trigger for immediate drastic alterations to stock investment strategies. It does, however, highlight ongoing economic questions and can have tangible real-world impacts, particularly on borrowing costs like mortgage rates.